In early 2020, two investors entered the market, David and Saul. Same money, same opportunities. Then the market crashed. Fast. Within weeks, trillions of dollars disappeared. David panicked. He opened his portfolio, watched everything drop, and sold. Saul saw the same thing. Same losses. Same fear. But he did something that didn't feel natural. He kept investing. Fast forward a few years. The market recovered. Companies like Nvidia surged as AI took off. Saul's portfolio didn't just recover, it multiplied. David? He's still waiting for the right time. So what did Saul understand that David didn't? And if you want to understand how money really works in moments like this, subscribe, because we break this down every single week. Lesson 1. Expectation shift. Here's the first difference. David thought the crash was unexpected. Saul didn't. Because smart investors expect crashes. Think about it. 2000, dot-com crash. 2008, financial crisis. 2020, pandemic. Every time people say, this time is different. And every time, the market eventually recovers. Saul wasn't surprised. He was prepared. Lesson 2. Timing illusion. After selling, David waited. I'll get back in when things feel safe. But here's the trap. The bottom never feels like the bottom. It feels like things are getting worse. So David waited. Meanwhile, the market quietly started recovering. Then quickly. Saul didn't try to be perfect. He just stayed in. Let's pause for a second. Because this is where most investors fail. Not because they don't know what to do, but because they can't do it when it matters. Lesson 3. Business thinking. When prices dropped, David saw danger. Saul saw something else. Opportunity. Because smart investors don't just look at prices, they look at businesses. Take Nvidia. Before the AI boom, it was already building critical infrastructure. The crash didn't destroy the company, it just lowered the price. Saul understood that. So while others sold, he was buying strong businesses at discounts. And this video is supported by cryptoevangelist.ai, a free platform where you can learn Web3 and digital age skills, because understanding how money works today is becoming just as important as earning it. Lesson 4. Emotional control. Now here's the real challenge. Emotion. David checked his portfolio every day. Every drop made him more anxious, until he couldn't take it anymore. So he sold. Saul felt the same fear, but he didn't act on it, because he understood something simple. The market tests your patience before it rewards you. Lesson 5. Investing when it feels wrong. When markets fall, most people stop investing. They wait for clarity, but clarity comes after the opportunity is gone. Think about 2020. Everything felt uncertain. But at the same time, a major shift was forming. Artificial intelligence. Companies like Nvidia began a massive run. But here's the truth. That opportunity didn't feel obvious back then. It felt risky. That's why most people stayed out. Saul didn't wait for comfort. He stayed consistent. Lesson 6. Long-term thinking. David was thinking months. Saul was thinking decades. That's the difference. Short-term thinking turns crashes into fear. Long-term thinking turns them into opportunity. Because over time, markets have always recovered, but only for those who stayed long enough. The crash didn't decide the outcome. David and Saul faced the same market, the same fear, the same uncertainty. But one reacted emotionally. The other stayed disciplined. And that changed everything. Because in investing, Success doesn't come from avoiding crashes. It comes from surviving them. Now, I'm curious, if the market dropped 30% tomorrow, which one would you be? David or Saul? Let me know in the comments. If you want to understand money, markets, and investing at a deeper level, subscribe to TMAStreet, because here we break down the ideas behind wealth, so you can make smarter financial decisions. And if you want to go deeper into how money is evolving, check out cryptoevangelist.ai in the description.